When asked to weigh these two stories, Angelo's senior equity analyst CFRA said, "I'll start with you on this one, Apple or Nvidia, if you're selecting one to enhance at this time. Compared to some of the multiples offered by both businesses, you're paying a little bit more for NVIDIA, but not by much." He says, "Yeah, for us it's still Nvidia. I mean, that's really going to continue to be the major driver in terms of AI monetization here over the next 3 to 5 years. I don't think there's really much doubt in that." Regarding NVIDIA's content growth story, it seems like you're moving toward Blackwell. This is in addition to the ongoing trend towards a greater number of total system sales, meaning that in addition to GPUs, CPUs, and networking chips, there is also a growing consumer market. Over the past 15 to 18 months, the majority of attention has been on the cloud. But in the future, there will be more enterprise adoption and greater opportunities for sovereign artificial intelligence. Thus, despite this significant action that you have witnessed from Nvidia, we are still quite excited. The company's cutting-edge chips power the majority of businesses developing new applications in the AI space, and the stock has benefited from some of the strongest secular tailwinds. However, there are many other catalysts that investors are pricing in today, and the company recently completed a 10-for-1 stock split with the stock maintaining strong momentum in the move. Over the next 15 to 18 months, it is likely to outperform Apple here over the next 3 years or so. Now that multiple firms have raised their price targets for the company, analysts are weighing in on the split and what it means for the stock. In today's video, we'll discuss one of these organizations, Barclays, which was among the first to raise its price target for Nvidia. In addition, we'll discuss why Nvidia is still the best AI stock available after the split. But before we dive into today's video, you can subscribe to our investing tutorial channel to stay up to date on the latest news about the stock market and Nvidia's updates. We also discuss the biggest changes in catalysts in the market. We provide you with 2 options when you ask Dan Flax the same question. Dan queries Nvidia or Apple, whichever name you select. Tim Cook Jensen Huang responds, "We still own both names for new money." NVIDIA's story is actually quite similar to Apple's in that both companies have reinvented themselves. While Nvidia's history was in gaming, they have obviously pivoted and really helped to reimagine the data center across many different elements. The key there, and we recently heard about the Rivian platform that will come out in a couple of years, is that they're continuing to innovate. This is why I would have a slight preference for NVIDIA in this case. The important and sometimes overlooked component of both companies is the empowerment of these developers when you get millions and millions of people riding to your platform and building something extremely sticky on top of what you've done, which benefits Apple and Nvidia in periods of slower growth. However, I think Nvidia remains well positioned in the data center, and I continue to like Apple as a play and an interesting and attractive growth story in mobile. Apple continues to empower developers to build on top of their platform, which is a data center comment. A number of high-flying stocks have benefited from stock splits during the recent tech-driven bull market. For NVIDIA in particular, there are many more reasons to buy the stock than just the split. The company is likely to continue to benefit from sovereign purchases of AI chips, as well as widespread corporate adoption of these chips as its order backlog increases. At this point in time, NVIDIA's potential for profit growth appears to be limited only by production capacity, which is likely to result in even greater growth than many analysts have already priced in. Nevertheless, it won't deter them from attempting to stay up with the stock's spectacular growth. In fact, Barclays analysts recently raised their price target for Nvidia stock from $120 to $145, indicating a 20% gain over the firm's current trading price. The firm's overweight rating on the stock is maintained by this change. So why did Barclays choose to target Nvidia stock at this positive price? Let's investigate Target. In addition to raising its price, Target on the stock, Barclays has also increased its revenue projections for NVIDIA to $157.1 billion for the fiscal year 2026 or calendar year 2025. This increase is due to the estimated $25 billion in additional revenue from AI products from the sovereign AI opportunity, which is anticipated to pick up speed in the upcoming year. The analysts further noted that Barclays is going all in on Nvidia thanks to sovereign AI, and you can't really blame them for that, as this is a massive yet frequently overlooked opportunity for NVDA. In fact, the global AI in governments and public services market is projected to expand at a compound annual growth rate of 16.9% from 2023 to 2030, reaching a value of $51.78 billion that year. The analysts also noted that the new revenue projections add approximately $0.61 in EPS on a post-split basis, and that they've reached their $145 price target by applying the same 40 times price-to-earnings multiple to the new EPS estimate of $3.62 for fiscal year 2026. Since Nvidia is known for exceeding expectations, we can't really rule that out. Additionally, last month, the company stated that it expects sovereign AI spending to account for $10 billion in revenue in 2024. If demand for sovereign AI continues to rise, Nvidia will be able to diversify its revenue sources and increase its profitability. While this may sound a bit optimistic, if Nvidia manages to capture 90% of this market, it could generate an extra $45 billion in revenue by 2030. And since Nvidia is known for exceeding expectations, we can't really rule that out. If you watched the entire video, thank you. It takes a lot of work and time to create these, so if you liked it, please hit the like button and subscribe to the channel. Your support will really help us develop. Now, back to the video. And Dan, while it's generally accepted that the split is insignificant and technically correct, I'm also interested in whether you believe it to be a motivator for regular investors. In particular, it can be the case for some that the stock is plainly less expensive, making it more affordable to purchase a single share from a revenue-generating company. The key for NVDA, as we have seen, is that if they are able to grow their free cash flow, it doesn't really matter. If you look at industries like healthcare, drug discovery, fraud detection, climate change, digital wins in manufacturing environments, these new use cases can create value whether the stock is at, say, $1,200 or $120. So we still like that name. Many analysts also anticipate that the recently completed 10-for-1 stock split will fuel the rally that has sent Nvidia stock up 150% year to date. This is due to the fact that individual investors who previously were unable to purchase Nvidia stock for more than $1,200 per share are now anticipating purchasing at the lowest split-adjusted price. Additionally, investors who already own shares may be persuaded to purchase additional shares at the reduced price. Furthermore, there are rumors that the stock split might result in Nvidia being added to the Dow Jones Industrial Average. In fact, some analysts speculate that Nvidia might replace Intel in the Dow. If Nvidia were added to the Dow 30, this would also lead to an increase in the purchase of Nvidia stock because shares would need to be purchased through mutual funds and exchange-traded funds, ETFs, that track the performance of the Dow. Additionally, we should bear in mind that equities often do well following a split. According to data from Bank of America, average returns for firms in the year following a split are approximately 25%, compared to 12% gains for the S&P 500 benchmark index. Additionally, Nvidia keeps innovating and expanding into new and expanding industries, which is fantastic for the stock. The business recently revealed that it will be introducing the Rivian line of artificial intelligence processors, which will take the place of Nvidia's Blackwell brand of chips, which was only unveiled in March of this year. The rapid turnaround indicates how fierce the competition and demand have become for AI semiconductors and microchips. It indicates a shift in mentality. Both the pricing and the accessibility have changed. This business is increasing at a rate of 250, 260, and 270% annually, and its earnings are up 450%. Its earnings could be far larger than those of other companies. For the foreseeable future, the company's largest clients will purchase every chip it produces, and enhancements are already being implemented. Rivian and Blackwell rivals of Nvidia, we can categorically state that Nvidia is taking the competitive threat posed by Intel, AMD, and others seriously because the two companies just unveiled new AI chips designed to go straight after Nvidia. Approximately 75% of the global market for AI processors is still held by Nvidia. The stock to own in the present market upswing is still Nvidia. The company's share price is rising, and the gains are likely to accelerate following the recently completed 10-for-1 stock split that has attracted retail investors. And through that dominance, the company managed to achieve blockbuster financial results and a share price that has climbed more than 200% in the last 12 months. For all of these reasons, Nvidia stock is a buy. In addition, the company's newest line of AI processors and membership in the Dow Jones Industrial Average will only increase the momentum propelling the shares to new heights. Nonetheless, what are your thoughts on Nvidia's stock? Is it worth buying at the moment? Please let us know what you think by using the comments area. If you'd like to know what businesses similar to Nvidia have been up to lately, don't forget to let us know what you think Nvidia is worth. As we wrap up this video on Barclays Bank's bold prediction that Nvidia stock will surge 20% very soon, it's evident that Nvidia continues to be a major player in the tech and semiconductor sectors. With its cutting-edge advancements in AI, gaming, and data centers, Nvidia has positioned itself at the forefront of technological innovation. Barclays Bank's confidence in Nvidia's stock surge is underpinned by these technological strides and the growing demand for high-performance computing. Investing in the stock market always carries risks, but understanding the underlying factors that drive a company's growth can help you make informed decisions. Nvidia's robust financial performance, continuous innovation, and strategic acquisitions are some of the key reasons why analysts, including those at Barclays, are optimistic about its future. If you're considering adding Nvidia to your portfolio, now might be a good time to conduct thorough research and assess your investment strategy. While Barclays' prediction is promising, it's crucial to approach stock market investments with a balanced perspective. Diversifying your portfolio, staying updated with market trends, and consulting with financial advisors can help you navigate the complexities of stock trading. At Investing Tutorial, our goal is to equip you with valuable insights and analysis to support your financial decisions. If you found this video informative, please give it a thumbs up and share it with others who might benefit from this information. Don't forget to subscribe to our channel for more updates and expert opinions on the latest market trends. We'd love to hear your thoughts on Barclays' prediction and Nvidia's growth prospects. Do you agree with their analysis? Are you planning to invest in Nvidia? Share your views in the comments below. Your feedback helps us create content that is relevant and useful to our audience. Thank you for watching, and stay tuned for more insights and updates from Investing Tutorial. Here's to making informed and successful investment decisions.